Hey everyone, and welcome back to the channel. Today I'm going to talk to you about the Bollinger Band. This is a really nice indicator that is used to know when the market is having an excess of volatility. So this is a bit different from the other indicators we've seen, and I think you can get great value from this from using it in your trading. Let's get into the charts. I've already marked the areas in 4 hours, so just quickly to show, here there has been a consolidation. The market has been just moving up and down there, so that's a nice support. And I see there's 2 weeks of rejection in this area, and then we go up to here, and I see this is the order block before this little correction. So let's see if the market goes up or down. But anyways, that's where we are now on USD CAD. And I've put on the Bollinger Bands, so it's an indicator always available on TradingView. You can just type Bollinger Bands, and there it is. And I will also show there's another version of this Fibonacci. Maybe I'll do a separate video on that. Okay, so what are the Bollinger Bands? They are basically an indicator that mixes the moving averages. So in the middle, we have just a simple 20 moving average. Then we have two bands, the upper band and the lower bands. And the formula of this indicator is that it takes into account the standard deviation from the moving average. So in other terms, if the market moves away from the moving average, the upper band will allow us to measure the distance of volatility between what the price volatility was in here and moving in a certain range of price to what it is now, where you can see sometimes the price moves really far away from the normal moving average. And the lower band is basically this same standard deviation that we have measured, for example, here when we have a lot of distance between the moving average, that this distance is calculated with a standard deviation, and we add that to this upper band to get this line, and we subtract it from the moving average to get the lower band. So in other terms, the market is going in one direction very strongly, then there is a lot of volatility. And when this happens, you can see that the distance between the upper Bollinger Band and the moving average increases. And as a result of that, because the formula also subtracts it on the lower band, we can see that this also stretches and there's a huge gap. Usually it's very similar up or down. And it's basically showing with this kind of volatility, it's also possible that the market has enough momentum to just go all the way down. Then what I would do with Bollinger Bands is that I would draw my areas of support and then just wait for a break of the area, and to know that we're not anymore in a ranging market. So to avoid fake outs potentially, we can just see what is the Bollinger Band doing. So let's go a bit here, and we have this big candle that's a break of this support zone. And that's in itself quite a nice sign that, okay, we might be reversing. And at the same time, we see that volatility seems to be coming back because the Bollinger Bands were pretty close to the price, and now they're really increasing in distance. So what we can do is we just enter on that candle, we go on the top of our zone, and we can just target simply a 2 risk to reward because then we are just targeting this next zone. Now let's see if this works. And we do get it almost. Yes, now we have it. And we can probably even just start to leave here if we see our target is not hit, because that means that there's very little volatility. The market is just consolidating on that support, and the Bollinger Bands are once again very close to this and very tight. So this would be a very nice and easy trade to see. And note that we just waited for a retest of that zone. We didn't just enter here, because if we did, we would have a pretty bad risk to reward, or then we might have to be a bit more aggressive. I'd like to just be more safe and conservative. So I wait for this retest somewhere here. Maybe we just wait for this little candlestick of hesitation, and then we see there's another going down. So this is typically a candlestick pattern. I will make a separate video on candlestick patterns because I mention them all the time. But this is very important to know what the candles mean. And in this case, we have this very big bearish candle that is showing the market has momentum, and this is confirmed by our Bollinger Bands because we also even break the Bollinger Bands. So that's quite a strong signal. Now, another idea that people have had with Bollinger Bands is called reverse to means. So it's a type of strategy that technically could even work without using a stop loss. This is what people do with trading bots are using sometimes. And the potential gains are really amazing, but the risk of not using a stop loss is also really, really big, and you can blow off your account. So I would not recommend using this. But we can still use this return to means. And the basic concept is that almost every time that the market has a big move up, it is going away from this moving average. And that's a market anomaly. It's not supposed to be that far off from the moving average. So we can infer that it will very probably come back to retest at least this moving average. And here we can see we have this big move up, and then we go back and touch the moving average. So the idea of this type of strategy is anytime the price just crosses from below the moving average and go to destroy and go through this upper Bollinger Band, here we see this candle is going away and even outside of it, then we enter the trade. And you have to be really quick because typically these kind of move are very fast. So here on the 1 hour, you have plenty of time to do it. But if you do this on the 5 minute or 1 minute time frame, it's going to be really hard to time this. And this move could just be like few minutes or even seconds. So be careful not to miss this. And I would recommend this on higher time frames. And instead of just targeting this level, we would simply wait for the price to retest and then exit the trade when it does. So the thing with this is that you just get very small entries and very quick trades. But at the same time, if the market is ranging, you can take the trades and just get stopped out very often. So you have to get quite a nice timing with this. And for instance, here you would basically not make any money or even maybe lose a bit with this trade. So that's the problem. And that's also why some people find other indicators like the RSI or the MACD to filter out these signals, because a lot of the times if you do it, you can just constantly go in and out of the market. Because here, for example, we do break the we do break the Bollinger Band, but then we also go back at the same level, almost even a bit lower, and then we do touch the moving average. So that would be a break even at best and maybe a small loss. But that the good thing with this is that you don't have a really strong stop loss. So potentially you can just track it and leave it to run all the way. For example, here you would just put the stop loss at the other Bollinger Band, because that means that volatility is probably not going to go much higher than this if it were to reverse strongly in the other direction. So you put your stop loss there, and then you just wait for the price to retest, and we would get that here, and that's like a 2.7. That's not bad actually. It's just you have to be careful because it's not going to work every time, and you have also to probably use some other signals to filter that. I might try to make another strategy on this to really exploit this revert to means, but I think it's also quite hard for beginning trading, because you don't have any hard stop loss and you need to constantly be watching the price. And when you do that, you're very likely to just question your analysis and wonder, oh, what did I do? Did I do it right? and eventually just mess up with your trading strategy. It's very likely to just wait. Okay, maybe I'll just leave it run a bit more and see what it does, and then eventually just change your mind here. So that's why I recommend to just go for the simple approach, which would be to wait for a break of the Bollinger Band, or at least to see that they're very far away, and just then wait for your classical signals like breaking of support or resistance zone and trend continuation signals. So that's it for today's video. If you have any comments, if you have any more signals that you like to use with Bollinger Bands, well, please share them in the comments. I'm also curious to know, and I'll see you in the next one.